Welcome to the Fear and Greed Business News Afternoon Report for Thursday, the 16th of January, 2025. I'm Sean Aylmer. Every afternoon, we've got the 5 stories that happened today that you need to know about. Story number 1, the local share market ended up nearly 1.5% today. It rallied after US price growth figures overnight. They came in lower than expected. More of that in a moment. That pretty much eased fears about inflation in the world's biggest economy, sending Wall Street higher. And our local market followed. The big banks surged, some jumping by up to 3%. In fact, Commonwealth Bank closed today up 2.98%. Very good day for the country's largest company. Rate-sensitive tech stocks and property companies also outperformed. The underperformers were those that are less reliant on the economic cycle, those that move less when it comes to interest rates, things like healthcare stocks, consumer staples, the big supermarkets in that instance, and utilities. If we go to stocks specifically, Zipco, the buy now, pay later group, surged after its competitor Sezzle upgraded revenue guidance overnight in the US. Neuron Pharmaceuticals rebounded after a tough session yesterday. Tabcorp Holdings jumped after announcing its first chief wagering officer. By the close, the S&P ASX 200 was up 1.4% to 8,327 points. Story number 2, I referred to it in the previous story, the Aussie job market is on a tear. In December, 56,300 new jobs net were created in the economy. Now, there were a stack of part-time jobs and a loss of some full-time jobs. Still, there's no denying the labour market is strong, with the unemployment rate now at just 4%. What's that mean for interest rates? Well, it will give the Reserve Bank a reason not to do anything anytime soon. In fact, no need to rush on interest rates when it comes to the Reserve Bank. That's what market economists think. They probably won't do anything for the next couple of months. Story number 3, US inflation figures were released overnight. They were weaker than expected. So now investors think there might be more than one rate cut in the US this year. Core CPI was up 0.2% last month. Multiply that by 12, 2.4% for the year. And previously, the previous 4 months, it was 0.3% or more. So that is a significant drop in that core CPI rate. Oil prices are definitely on the rise. That will put inflation pressures into the system, and it will also hit our petrol pumps in 2 or 3 weeks. US crude inventories are falling, and there are fears around supply, particularly around Russia and Iran. A barrel of oil is now fetching about $82. Story number 4, Rio Tinto faces more challenges from the West Australian iron ore mines, which provide the bulk of group earnings, as it continues to ship higher volumes of lower grade material to Chinese steelmakers. The company was forced to draw down on mine stockpiles towards the end of last year, during what's typically the most productive quarter for iron ore operations in the Pilbara, according to a report in The Australian. Heavy rain flooded some mining pits, forcing Rio to eat into stockpiles it prefers to build up, with the period from January to April considered a higher risk period for disruptions caused by cyclone activity. Rio warned iron ore production costs for 2024 would be at the higher end of guidance based on lower output and inflation outstripping internal expectations. On the global economic outlook, Rio said in its quarterly production report that inflation is moderating, growth stabilising, but risks posed by geopolitical tensions and persistent labour shortages are back. Rio, which believes iron ore demand has peaked but will remain strong, said the Chinese economy provided mixed signals in the last 3 months of 2024. As for the US economy, in particular the tech sector, well, it had outperformed other developed economies, and its outlook remains stable in the countdown to President-elect Donald Trump taking the reins. And finally, story number 5, many of the world's richest economies will need to at least double productivity growth to maintain historical improvements in living standards amid sharp falls in their birth rates. That's according to a McKinsey report investigating the economic impact of declines in birth rates. It found that in the UK, Germany, Japan, and the US, they'll all need to see productivity rise at double the pace it's been over the past decade to maintain the same growth in living standards. A report in the FT says that to match GDP capita growth between 1997 and 2023, productivity growth in France and Italy will need to triple over coming decades. In Spain, it needs to rise fourfold. The report highlights the impacts of declining birth rates on the world's most prosperous economies, leaving them vulnerable to a shrinking proportion of the population of working age. Australia's productivity pace would need to increase by about 25%, according to the report. That's it for the afternoon report for Thursday, the 16th of January, 2025. Make sure you hit follow on the podcast. We'll be back tomorrow morning with the Friday edition of Fear and Greed Business News. I'm Sean Aylmer. Enjoy your evening.